your credit and your debt to income ratio really those are two totally different things. They're not dependent upon each other. These are two different factors that the lenders look at to see if you're actually lendable or fundable. So let's say you wanted to borrow $200,000 to buy a rental property to supplement your income, to create that financial freedom and have some more passive income coming in. All right, so so they're going to want to see your credit score above 700. They're going to see your utilization under 30%, and they want to see your debt to income ratio below 45%. All right, so how much of your income coming in goes towards servicing your debt? Right, that's what they're looking at. Let's here's a sample 2-income American families monthly income statement. What you're seeing is their gross salary of $6,600, and then of course they have monthly taxes of $1,600. That's their income tax, and then they have their mortgage payment and their student loan and their car payment and their credit card payments, and they've got a retail card in there, and then there's their whole lifestyle expenses, all their other bills, you know, and then total expenses $5,000. Okay, so let's look at when the lender calculates your DTI for their formula. What they do is they look at your fixed expenses and they divide that by your gross income. So your fixed expenses are like your loans, right? They don't change. Versus like a credit card, which could change, or your power bill could change, right, from month to month. So we're looking at your mortgage payments, school loan, car payments, so your fixed expenses, and we're dividing that by your gross income, right? So this is the lender's debt to income ratio, the formula that they're looking at. So if we add up the fixed expenses, that would be $1,600, and we divide that by the gross income, which is $6,600, you get a debt to income ratio of 24%. Okay. So if your credit score is above 700, your utilization is below 30%, and according to this DTI formula, you're at 24%, would you qualify for the $200,000 loan?
According to this, you'd get approved.
Absolutely. So, but I have to ask you, Ray, do you live off of your gross income?
Never. No. We have all sorts of other things.
And are your fixed expenses your only expenses?
Nope. We have all those other life events and non-fixed events.
So let's talk about what a living DTI is. This is what we experience in real life, which would be our total expenses divided by our net income. So our total expenses would be defined as the fixed expenses that you see on that monthly income statement, plus all the other expenses that are there as well. And then your living DTI, if you want to calculate your net income, you take your gross income, subtract your monthly income taxes, and to find out what your net income is. I mean, your taxes, income taxes, FICA, your Medicare,
Social
Medicaid,
Security, yeah.
right, Social Security. And so then you have your net income. So if we take total expenses and we divide it by the net income, now we're going to have some differences. So 1,600 plus 1,800 will be our total expenses. And then the net income of 6,600 minus 1,600 will give us our net income. So now we've just jumped from 24% DTI on the lender's model to now 68%. So 68% of this couple's, this is a two-income American family, 68% of their income is servicing their debt. Woo! So if we base that off of the DTI model up there, that you really should be under 45% to qualify for this $200,000 loan, would they qualify here?
No, they would not.
They would not qualify, of course not, because they need to eliminate some of their debt first to get that under that 45. But you know, another thing that's not taken into account here is, well, what is that new payment going to be for the $2,000 loan? Because they are thinking about using this as a rental property. Mm-hmm. But even you know, as being a landlord and you have rentals, are they always rented out every single month?
Nope.
So there's vacancy.
There is.
And so you have to plan for on those months where you pay for everything.
Sometimes you get a good tenant, they'll be there for a couple of years. Other than that, you know, might be every year you could be changing a unit.
So, I mean, how many months in a year would you plan budget-wise to make sure that you had enough money to cover that loan?
I'd say a good rule of thumb that we use is about 80%.
So 80% of the time It's occupied, so you need to 20% of the year be planning to pay for that.
Yep, plan for 20% vacancy.
Okay.
Now, if you run, full occupancy, then you're good.
Well, look at this. If we add in to the total expenses an extra $1,200, look where the DTI goes to from there. 92%. There's really hardly no room. What if the car breaks down? What if there's an emergency medical bill? I mean, if anything goes sideways on this couple, they're going to be hurting. And so let's say the tenant doesn't move in. Let's say the government says that your tenant doesn't have to pay their rent.
Doesn't mean you.
But you still have to pay, right?
Right.
So here's the situation. Now you've got this 2-income family, and they're working overtime. They're trying to get a second job. They're working a side hustle. You've got the parents now aren't able to be home with the kids or the spouse. So now we've got marital issues, parenting issues, all these things creeping up. And before you know it, these people are headed into foreclosure, bankruptcy, and their marriage is on the rocks. This isn't what they planned for. This was supposed to be that passive income. This was supposed to get them to where they wanted to be. How did it come to this, Ray? How did it all fall apart?
Well, it simply comes back to putting too much trust into banks, lending institutions to
what?
Think that they have our best interests in mind.
Are you saying that the lender, when they qualified them at the 24% DTI, did something wrong?
The system is just simply rigged against us.
So is it in the lender's best interest to approve these people for a loan?
Well, and see, that's the thing is these folks are probably more qualified than most. And that's the unfortunate part. It is,
but it's in the bank's best interest to qualify them for a loan.
It is. They want to make money.
And many people look to the bank or the lender as like a fiduciary, as somebody who's going to make wise financial decisions. And so the bank wouldn't have qualified you if you weren't actually qualified.
And they're okay with lending that money because they're first position on a piece of real estate.
Right.
And if something goes south, then they just take the property back.
Not only that, but they also have mortgage insurance.
Absolutely.
So they can get paid back twice for one piece of property, right? Because the insurance will pay them back for any missed rent, and they can sell the house and get their money back.
Yep.
So they actually, what's their risk?
They have very little risk.
Exactly. So, but this couple's taking a whole bunch of risk here. Now, here's the point. You can't trust other people to be your financial advisors. You've got to get educated. You got to learn how to become your own financial advisor. You got to run your own numbers. And when you do your own expenses and you look and you see that if I take on the new loan payment and I look at my DTI is going to be 92%, that maybe, just maybe, I need to focus on eliminating my debt as quickly as possible so that I can get that DTI down to a manageable amount so I can take on new debt.
Joseph, the thing that really hurts about this situation is then when somebody is in this situation, that's when they say real estate doesn't work.
Well, that's true. And the problem with that is that real estate does work if you're educated, if you know what you're doing. And that's why people are tuning in here, because you're getting educated, you're learning, oh, wow, DTI, debt to income ratio. I didn't know that the banks looked at it that way. And because that's not really real. We don't do fixed expenses over gross. And so we live totally different. And so once you become your own financial advisor, right, and you realize that the banks, they're a for-profit company. They're in business to make money for themselves and their investors. And so you have to be in the business of making money for yourself and your investors. And there's a lot of different ways to get into, a $200,000 property where you don't have to use any of your own money or credit. But that's for a whole nother topic for a whole nother time. But if you are going to take on new debt, you need to know what that's going to cost you and how that's going to impact your debt to income ratio. Because I guarantee you that if your debt to income ratio is too high, there ain't nobody who's going to lend you money for anything. I mean, think about this. A lot of people think, well, I've got a lot of equity in my house. Go to try to access your equity through borrowing against it, through a line or a loan. And what's the bank going to do? They're going to check your DTI and they're going to say, oh, yeah, you've got a ton of equity, but you're at 92% debt to income ratio, so we can't lend to you. And so it's like, what good is your equity if you can't access it? So you're like, that's it. I'm going to sell my house and get my equity. Great. So does that mean you now live on the streets? I mean, no, you got to go buy another house. You got to live somewhere. So this is a challenge for some folks here.
Or you do a cash out refi and we'll restart you all over again.
Isn't that wonderful?
Thank you for being here today, folks. If you want to know more about how to get out of debt, how to understand your debt, how to grow and build your wealth, go over to wiseguysandties.com. And here, if you look for the event tab, you'll be able to see that under the events section, we have 4 free weekly masterminds and webinars that take place. Thursdays at 2 Pacific Standard Time, we have How to Build Your Business Credit. Tuesdays at 2, we have Business Credit Accessing Direct Funding for Your Company. Credit Banking Mastermind, it takes place at 6 o'clock Pacific Standard Time. This is where you are going to learn the tips and the tricks to beat the bank at its own game, where you'll be able to eliminate your debt in 1/3 the time. Also, check out the Real Estate Investing Mastermind if you are really serious about growing your wealth. Thursday nights, 6 o'clock Pacific Standard Time. We look forward to helping you out. There's also lots of other resources on our website for you. If you're interested in finding out more about business credit, you can go here for articles, books, and then of course there's always the 30-minute free consultations if you want to set up a time. Make sure you like and subscribe. Other than that, good night and God bless.